We see a string of upgrades for public sector banks and new private sector bank giants, like ICICI and Axis. But the real stars of 2022 in the banking sector space have been the old private sector banks. Heading the list is actually Karnataka Bank, with the stock rising 148% year to date, followed by Karur Vysya at 136%, and then South Indian Bank, which is up 103% stock price year to date. To understand what's going so good for the old private sector banks, I have with me two important representatives, Mr. M.S. Mahabaleshwara, Managing Director and CEO of Karnataka Bank, and Murali Ramakrishnan, Managing Director and CEO of South Indian Bank. Gentlemen, good morning and thank you very much indeed for joining us. Let me first start with the margins, which is where both of you have performed so much better than your own previous records. Mr. Mahabaleshwara, is this good to go for a little longer? Can your margins improve this quarter, next quarter as well?
I'm definitely optimistic, but this is the time to be cautious also. Margins is one area which is engaging the continuous attention of any bankers. But if you look at the slight increasing trend that we are seeing in the cost of deposit, I think my margin, which is presently at 3.56, I have given an indication that it could be somewhere around that or even maybe around 3.40. I'm not that very bullish on the margin, but for me, for the current year, maintaining it at that particular level, given the interest rate increasing scenario, appears to be realistic.
Okay.
I don't know what is the view of Mr. Murali.
I'm getting Mr. Ramakrishnan on the same issue. Mr. Murali, your thoughts?
Yeah, I pretty much agree with what Mr. Mahabaleshwar is saying. But as far as South Indian Bank is concerned, we were, if you recall, a few quarters back, we were at about 2.6%, and then we have continuously improved our margins. And as we talk, we were close to 2.98 to 3% when we were at Q2 end. I am hoping to see a very marginal uptick probably in Q3, and probably then it will stabilize in Q4. So overall, I'm looking at 3.2% by the end of the year. That's the margin which I'm looking for.
Okay, that's still an impressive margin compared to the recent track record of the bank, or the historical track record of the bank. Mr. Mahabaleshwara, let me now come to loan growth. I mean, the industry loan growth is very good at 17.2. No, that is the Reserve Bank's number on Friday. And your own previous records are excellent. You have done about 20% before COVID, before asset quality review. You were at in 2018-19. Now in single digits. How is loan growth looking?
No, loan growth is not in single digit. In fact, we had grown at 10.18%. I am optimistic that it would be somewhere around mid-teens as far as the loan growth is concerned. Madam, we need to understand that economy is definitely passing through challenges, but the response by the regulator and the bankers is also equally strong. So definitely, I think we are all poised to go to the pre-COVID level. So keeping that in mind, I am optimistic that we can grow a healthy growth at the mid-teens for the current year.
One minute,
next year, it would be at the upward revision is quite possible.
Okay, no, 1 minute, Mr. Mahabaleshwara. You're saying that you're going through difficult times. We thought the difficult times were behind us. Are you expecting that some of these ECLGS loans or something may fall bad? What do you mean by difficult? And secondly, is your problem deposit growth? Is that not growing as fast as you would like it to? And is that constraining loan growth?
Yeah, when I said about the economy is passing through the challenges, I referred mainly to the inflation.
Okay.
So what the RBI governor has also mentioned that the war against inflation is not yet over. That has to be kept in mind. That is the number one. Second one, as rightly pointed out by you, the restructured portfolio of the banks. So that is also engaging continuous attention of the bank as far as my bank is concerned. So it was somewhere around 8% of my this total book, and now it is already at around 5%, and the quality is also improving. But the point to be noted there is some portion of that particular loan, the repayment is yet to start. So the next 2 quarters is very crucial. But of course, I have already constituted a restructured asset management cell headed by a general manager cadre officer as well as another executive. We are reaching out to the customers, and the field level conditions we are closely watching. And depending on that, our response would be. The second point is that we are still holding around 18% this provision for this restructured standard advances. So that type of contingency measures we are also taking, and we are cautious. Even though the quality, we are not concerned too much, but it is an area which should continue to engage our attention going forward also.
Okay. Let me come to deposits actually. For both your banks, that seems to be not at the best of... Mr. Murali Ramakrishnan, on that, deposit growth of only 1.9, is that a big constraint? Why aren't you all able to attract more?
No, as I said in the previous discussion with you, Lata, I think we need to be balancing out the exact situation where we are as a bank. So on one side, I need to be cautious about the NIM. I need to be cautious about the quality of assets I'm onboarding. And I need to be, therefore, cautious about the rate at which I raise my deposits. See, quality of assets will come only when you offer competitive rate in the market. Competitive rates will come only when you maintain your cost of deposits also at a decent level. So just to grow assets, if you keep raising your deposit rates, obviously your NIM will improve if you are going to offer, if you are offering at the rate which is higher than what you were doing. But that's a likelihood of for you also attracting not so good customers. So
No,
today,
I
even
take your
today,
point.
if you look
You
at
don't want
good
to
quality
take...
customers, they still demand very fine rates. And given the situation where we are in, where I'm trying to bring down my GNPA, net NPA, where I'm trying to improve my PCR, where I'm improving my profitability, NIM, etc. I need to be really playing this, as it is appropriate for our bank.
No, take your
Therefore,
point.
I'm not unduly concerned about my
I got it,
deposit
sir. Yeah,
rate.
caution is your reason. I get your point, and you don't want growth at any cost. I take that point. Let me come to the asset side of the book. There are some things which offset the lack of size. For instance, account aggregators. And now you have even the OCEN. Not much has been done, but that online credit enablement network has started. It's about 100 crores only has been given, I think, in that. But nevertheless, do you think that it's going to be a little easier to grow the asset book sensibly because of these digitalization processes, Mr. Ramakrishnan?
Yeah, as far as we are concerned, see, if you look at retail, we are present today fairly well in personal loan, fairly well in credit card and home loan. All these products, I can say that even without all this, we have an offering today which is completely digital enabled. So as far as credit card is concerned, we have tied up with the fintech, wherein every right from sourcing to entire fulfillment happens digitally. Of course, with the risk norms provided by the bank as per the respective capital. Again, PL is concerned, the entire thing is working on pre-approved as well as on input income model, where we have a credit model that supports our quality, and the entire thing can be offered digitally. So as far as home loan is concerned, probably we're the first bank to come out with even documentation being done digitally. Okay. So with all this, what we are witnessing is that home loan is still to arrest its degrowth, because we had a home loan book which wasn't very good earlier. We have completely revamped the process, we have completely revamped the products, and we have also come out with some more surrogate products, etc., with which we are now trying to grow the book in a most qualitative way. And I'm hoping to see that this will also turn around in maybe 2 to 3 quarters from now. Okay. So as far as other products are concerned, retail products are concerned, as of now we are treating cautiously, because as you know, auto kind of businesses are not that profitable unless you have a good mechanism to cover end to end, where you cover dealer funding on one side and you cover your sourcing on one side, which is going to be if it's going to be through any channel partners, etc., it's going to obviously incur more cost for you. So you'll have to balance it out in a way that your cost of
Mr. Ramakrishnan, I'm sorry I'm interrupting you. It's just that I have to try and cover both banks as well as I can in the time allotted to me. Mr. Mahabaleshwara, I wanted to ask you a similar question. Are you, trying to improve your asset book and reach of your, loan-giving ability because of fintechs and because of things like aggregators, account aggregators? Can you just draw up the next 1-2 year roadmap for us in terms of asset book growth?
Earlier, we were onboarding the customers, especially the borrowers, through our physical channels, that is the branches. Now, a lot of digital channels are available. I have already started my own analytical center of excellence besides the DCOE, Digital Center of Excellence. We have already tied up with good number of co-lending partners also. And in fact, for your information, we have already tied up with around 36 fintech companies, which are acting as enablers, not only the asset side, even the various other sides also, even the liability side. As rightly pointed out by my colleague, MD from South Indian Bank, Mr. Murali. So in each and every areas of banking is being touched by digital. So digital is the future. We are all geared up for that, to encash it to the best of the possible ways and to get very good margin improvement also. That is how we are all working towards improving the banking sector as such, as well as our own banks.
Okay. A very quick reply, Mr. Mahabaleshwara. Do you think that you may lose to private sector banks simply because they will be able to invest more in technology?
I'm already in the private sector bank and I am in the driver's seat.
No. I meant the larger ones. Mr. Murli, again, a single line answer. You think that they will invest more in technology and take away business?
The percentage of spends on technology investments, we are comparable to the best banks.
Okay. All right. Then can I get just two numbers?
Lag behind. We will never lag behind. Yeah.
Okay. I agree. Just two numbers from both of you. Let me start with you, Mr. Mahabaleshwara. Your best guess on margins in 2023, your best guess on loan growth.
Loan growth, as I said, it would be above 15%. Margin somewhere around 3.4 to 3.5%. That is what we had planned for the current year. Okay. And going forward, it is definitely going to further improve.
Oh, Mr. Murli?
As of Q2 end, we were at about 16% year-on-year growth as far as advance is concerned, but I would continue to keep my guidance at about 12 to 13% for the full year.
Okay.
As far as NIM is concerned, we were at about 2.98% as of September end. I am hoping to reach 3.2% by March end.
Okay. Thank you very much. I know that was a very quick wrap-up of the two banks. We'll try and get more time later on. But thank you very much for giving us a glimpse. Now we know why perhaps these are the best performing stocks in the banking space. Both banks are gunning for their best ever margins in the last several years, over 3%, and loan growth expected to be mid-teens. Wrap up on Bazaar Chartbusters. Up next.
Powered by